Good morning, everybody. Welcome today to the BVRLA Masterclass on ESG. Thanks so much for being with us, and thanks so much for being so on time this morning as well. We can get started straight away, which is fantastic. Just a little bit of housekeeping wise with Zoom. We will, I think, have one short break today, possibly. If we do have a break or if anything happens, please stay on the Zoom call. Just turn your camera off and turn your microphone off if you're leaving. So that we know that you're not around. But if you leave the call, sometimes it's hard to get you back. Any problems with tech, I'll put my work phone number in the chat box. If you need anything, if you completely lose connection, just drop me a text and I'll see if I can support you tech-wise. It's a 2-hour session today, and we just want to make sure that you ask as many questions as you can. So please feel free to use the chat box to ask questions, or to unmute yourself and speak on mic as well. We'd love that too. If you do have a camera available, please pop it on. It's lovely to see you. We are recording this session today. If you could just share the competition law slide, that'd be brilliant. Bear with us a second. So we do have competitors in the room today. So it's really important that we're aware of what we can and can't discuss. Or 1 second, Charlotte, I probably need to just make you codes. There we go. We do have to be aware of what we can and can't discuss today as competitors in the room. So we're just going to pop a slide up, and that'll tell us the areas to avoid today. So things like price changes, terms of sale, profit margins, that kind of thing we'll be avoiding today. If at any point you're unsure what you can and can't discuss, you can ask myself, you can ask Mark. Here's the slide. That's it, perfect. Brilliant. So if you can just all have a little look at that, particularly that red section there. So like I said, we'll not be discussing company prices, price changes, terms of sale, profit margins, and we won't be discussing matters related to individual suppliers or customers today. Perfect. Okay, lovely. I'll keep letting people in, and if Ben, you want to share your slides again, and I'll hand over to Mark. Thanks, Mark.
Yes, lovely. Thank you very much. Hello, everyone. My name is Mark Powell. I'm the Head of Learning and Development here at the BVRLA. Welcome to our 2-hour masterclass session on mastering the ESG landscape. This session will provide a clear and simple overview of ESG regulation, explain how your business can meet its obligations when sharing data with clients, customers, and partners. The BVRLA has left you in very safe hands today, as you'll be trained by ESG experts Ben Horn and Dr. Mark Lepere at Omnevue, who will provide you with this insightful online session. BVRLA, with a range of its members with financial grade auditable ESG data that is decision useful and that their customers, banks and investors can trust. And reporting is aligned with CSRD and SFDR and international accounting standards. Omnevue is also the trusted provider of knowledge and expertise and sustainability. They work with our ESG working group. They work with us, of course, here with the learning and development team. And at the end of today's session, you will have a unique opportunity for a 30-minute one-to-one chat with Omnevue to discuss your specific business needs. So if you'd like to take advantage of this fantastic opportunity, you can put a comment in the chat facility and we'll action this for you. But if you can't stay after the session, that's fine. And obviously Ben and Mark can't speak to everyone after the session. Still put a comment in the chat and we'll organise a meeting with Omnevue directly with you after the session. So I think this is the right time to hand over to Mark and Ben. I'm handing over to Ben initially. So welcome, Ben.
I was on mute. Hello, thank you very much, Mark. Really appreciate you all being here today, and it's been great to get a session with you guys to getting to grips with ESG. I work with Mark, Dr. Mark Lepere, who will be leading our masterclass this morning, and I'm just going to introduce him now. But if you have any questions throughout the morning, then please do just put your comments in the chat box, and we will kind of be with you as soon as possible. Over to you, Mark.
Hi, I'm Dr. Mark Lepere. I am the doctor because I lead ESG and sustainability for executive education, i.e. you guys, at King's Business School, King's College London. And obviously my main hat is Omnevue. And in fact, the company very much came out of my academic research and work. So fundamentally, three reasons. One was that smaller companies, small, medium-sized companies like ourselves, usually aren't really well catered for when the world starts going upside down, as it is doing in this space of sustainability and ESG. The money, all the solutions go after the big corporates and the big financial institutions, and we're usually left to fend for ourselves. So that's why one of the reasons we started Omnevue. The other was that, as Mark alluded to, there is the history of sustainability has been very much about, frankly, making it up, cherry picking. It's been a marketing exercise, CSR. It hasn't been about quality data at all. That's very different now because of the regulation. And obviously, that's very much what we're going to talk about today. Market drivers and regulatory drivers are changing people's attitude and understanding that ESG, sustainability, purpose, whatever you want to call it, is fundamentally about data. Once data comes into the equation, the only data worth having is good data. And in our language, that's financial grade and auditable. So that was the second big insight for starting the company. And the third one was, as Mark alluded to also, once you have financial grade auditable data, you can integrate it with financial data, and then it becomes useful for managing businesses. And as Mark said, it becomes decision useful, not just for you and your own business, but for all your stakeholders. So that's very much the background to the company. We'll take you through this as we go. These are the questions that were promised on the marketing material. I know we've got a lot of number ones, which is interesting. We will move on to number 2, 3, 4, 5, and 6, so forgive that. What I thought we'd do, just for a bit of fun, really, is and just because we've all been on so many. Sorry, Ben, go back to the beginning. Thank you. Just because we've all been on so many of these things, we really want to give you guys a chance to ask the questions you want. So I think what we'll probably do, frankly, is we'll do about 15 or so minutes, maybe a little longer on the first one because we've spent 10 minutes already, but about 10-15 minutes on each one of these. We'll ask you for a range of questions in these different spaces. Ask them. Maybe we'll take 3 questions at a time, Ben, if you could be in charge of looking at and marshalling the questions. Put them into the chat, or raise your hand, please. It'd be great if you raised your hand, but put them into the chat as well. And then we'll try and answer. We'll basically structure the conversation around each of these topics in answer to your questions, which I hope will make it more useful and targeted for you. There are, of course, the odd slide which we can refer to in our answers. There's a slide or two involved in some of them which might get the conversation going. So if that's okay, that's how we'd like to do it, because I think it's more interactive. So this is with my kind of teaching hat on. Does that make sense to everybody? Is that okay by way of an approach? Yeah? I'm taking silence to mean to be golden. Okay. Right. So context setting and background. There are obviously 1 or 2 handouts and things as well that we'll be giving. The other person I should mention, if he's on the phone now, is another colleague. Daniel, are you here? Just whilst we get doing introductions? Maybe not. Daniel's a colleague of Ben's as well. And so he will be.
Indeed. Sorry, Mark.
Good man, don't worry.
Everybody, my name is Daniel. I'm the CEO and founder of Omnevue. Sorry for jumping in a couple of minutes late. I didn't want to derail the conversation, but looking forward for the session today, and will be great to take any questions. And
great. So the kind of after the final half an hour, and indeed the subsequent meetings, Ben and Daniel, you'll be in very safe hands with those two, so that's great. Right. By way of context setting and background, Ben, do you want to just go to the slide we have? I think we've got 1 slide in here prepared. Yeah. I'm just going to talk to this, and I'll kind of get into the detail in a bit. But how many of you? I mean, let's start here. How many of you believe that your own organization, perhaps the management, the senior managers within it, still basically view ESG, sustainability, purpose, that they still view it really as a marketing exercise, a bit like CSR, if you like. Just put your comments into the chat, it'd be really helpful. Just a yes or no. So the question really is, do they still see this area fundamentally as a marketing activity, i.e. in pretty much the same way as they saw CSR? Good. Great. Okay. So a lot of people realizing that actually the game is shifting. And I think that's absolutely right. So the way we view it at King's primarily, but is the period of ESG 1.0, which effectively was from about 2004 until about, roughly speaking, 2018 or 20, was very much the marketing era of ESG, if you like. And I'm delighted to see that a lot of you think that your organization are shifting. In that period, ESG 1.0, it was really about cherry picking, self-assessment, say whatever you want, put one or two selected facts out there and then build a whole sustainability story around it. I mean, it was, if we're being honest with each other, it was greenwashing in the main. I'm not saying every company did that, but a lot of companies did. And greenwashing is very predominant in the market. And it's because of that the regulators stepped up and in 2018 announced a series of regulations, most of which have come into existence this year in 2024. So this regulated period is completely different to the voluntary period of ESG 1.0. So it's ESG 2.0. And this is a very different space. It's regulated, it's mandated on companies, certain companies to report at the moment. It will probably almost certainly move down the line, but for now it's certain companies. We'll talk about that. The point is, it is part of financial and non-financial disclosure requirements for companies. Okay, so they have to do it. Okay, and they have to provide giving 2 computers to the local school. So it's not only regulated, it's also fundamentally data-based. Okay, and that's a very different world. And that's the world we've entered. As I say, it's really taking effect this year. The key aspect of regulation, just to give you some color on it, you've basically got the EU is the most advanced regulator in the world. I'm going to talk about them quite a lot because even though we in Britain have left the EU, if you do business in the European Economic Area or are banking with somebody who does business in the EEA or have an investor who does business in the EEA or are supplying companies that do business in the EEA, it's going to be a lot of us, you have to report. You will be asked almost certainly for information that aligns with the EU regulation. And I'll explain why later. We can talk about it later on. But fundamentally, the EU is driving a lot of the thinking in this space and have enacted a whole host of things in January of this year. The British position on it is obviously we are likely to have a change of government sometime before Christmas. The Financial Conduct Authority is the regulator over here. They have already introduced quite a lot of things under a thing called SDR, Sustainable Disclosure Requirements, that are mirroring, slightly tweaking, but typically mirroring a lot of the EU stuff. And there's quite a lot of disclosures that are required already in the EU, even before they roll out over the next year or two more and more new regulations. So it's real for us. It's not going to be an excuse, in other words, because we're out, then we won't have to comply. It's not going to work that way. And the reason for this chart, if I can just start in the middle, is that there is regulation around financial institution regulation that affects investors and lenders. So the purple and the blue box there in the middle of the diagram, and separate but related regulation that affects corporates. Okay, so in terms of us, all of us listening, the corporates fundamentally are our customers, whether you're in a procurement process with a major corporation or a local government or central government, anybody like that, will be affected by this. I'll talk about how in a minute. If you're lending money, if you're borrowing money in any shape or form from a bank, anybody, you will be affected by this. And obviously, if you have external investors who in turn are taking money from larger financial institutions, you will be affected by this. And the top box is really just to indicate that all these regulators are working together in a pretty coordinated and networked fashion around the world, as I said, led by the EU. So the EU have a set of metrics, 21 metrics in all, that they require financial institutions, so the two boxes on the left, and big companies on the right to report against. It's the same 21 metrics, whether you're a financial institution or a corporate, okay? And one of the requirements in there is that these companies have to report on their carbon emissions, or their carbon equivalent emissions, I should say, their greenhouse gas emissions, not just for themselves, but also in their supply chains. And this is what we're trying to depict on this chart. So we are the little green circles here in these various supply chains, as I say, of our customers, of our banks, or of our investors. Okay. Now, for those of you who, and we'll come on to this in much more detail, perhaps in a further topic here, in a further segment of this, but there are basically three types of carbon. The stuff in value chains is called Scope 3, which many of you will have heard of. And that's how we get drawn into this. It's also worth noting that, I think we come to this later, Ben, don't we? That carbon isn't the only one. Is that correct?
Correct, yeah.
Okay, so I'll get onto that later. So the EU metrics we'll look at later on, I'll show you them, but they are inclusive of measures across the environment, so not just greenhouse gases, social metrics, and governance metrics. Now, all of this regulatory framework is underpinned by new accounting standards, which came out in June last year, in fact, and are being adopted by countries around the world. So about 40 countries are currently looking at adopting these new accounting standards at the moment. The British government have said they will do it by July. Maybe with the change of government, it'll be, moved a bit. I think it'll be sometime this year or very early next year, even with the new government. The point of these regulations, these accounting standards, is that they are a result of the financial world coming to the IFRS, that is the Global International Financial Reporting Standards body, that basically make up the rules around financial reporting in about 100 and something countries. The US have their own GAAP system, but it's very close. And these guys were approached by the investment world who said, look, we know that environmental and social issues are becoming detrimental to our investments, both in terms of physical risks, so wildfires, floods, etc., but also what they call transition risks, i.e. changes to business models, breakdowns in supply chains, lack of skilled labor, etc., etc. And we want you guys, the accounting world, to come up with some rules for measuring non-financial data, or ESG data, sustainability data, again, as I say, whatever you want to call it. Now, all the regulators have said they will adopt these new accounting standards as a bedrock of the regulation. So the British government have been absolutely categoric and have been one of the ones vociferously supporting the IFRS in developing these new standards. Therefore, I think it's almost inconceivable, given London's place in the global financial system, that they can not adopt them very quickly. Because the investors, i.e. the people who run and are the market in the City of London, have asked for them. They've also unanimously approved them in every country in the world. So the body is called IOSCO. They run the world's capital markets. So there is real change. It's fundamental. Is it all starting right now, next Thursday? No. Okay. But just to give you some timing, and then we'll stop for some questions. The EU taxonomy affecting corporates, banks, lenders, and investors came into force in January of this year. So companies now have to report. they've been given a year or two longer that they can use estimates instead of getting real data from you guys. So they've been given a little bit of an extension there, but the regulation's in place. Okay, so they have to report on their own 1 and 2. For now, they can do estimates, but in a year or two's time, they need the real data. Most smart companies are collecting the real data now. The banks have an additional piece of regulation which started again in January of this year and will be upgraded in July of this year, so in 2 months' time, whereby they are incentivized to report the proportion of their lending book that is sustainable. So if they're lending you money for whatever reason for your business, they want to be able to prove that it's a sustainable loan in some way. It's a big advantage to them. So they're going to start really squeezing everybody who's financing or refinancing. Okay, so the pressure is really going to start coming on from the banks throughout the course of this year. They again have been given some leeway by way of they can estimate for, I think, the first year, but then they have to get real. So they're kind of trying, you can see what they're doing. They're bringing in pretty strict regulations and then trying to soften it a bit by saying, well, you can have a year or two to estimate, but make no mistake, it's here. So 24 is a very big year. The last and final thing, any of you who are in the export, any way related to exporting to Europe, that's new regulation, which also kicked in this year. And basically anyone importing into the bloc has to fulfill and report on their GHG emissions as well. So 24 has been a big year. A lot of stuff that's been talked about for a long time is in effect, and it's starting to be real. And we're seeing, we do a lot of work with accounting firms, and we're seeing a lot of businesses now basically ringing their accountants saying, I've been given all these questionnaires, what the hell do I do? The bank's asking for all this data, what do I do? So I hope that's a background. Any questions, any comments, any thoughts? Ben, if you wouldn't mind going back to the agenda slide just for a moment so we can see yeah, thank you. And we'll go back here at the end of each little piece, if that's okay, Ben.
Yep.
Thank you. Okay. Anyone got any questions on that section? Thoughts? Everyone happy? I can't see you all, remember, so. Did most people know that? Was that a surprise? Is it no questions? Okay, I'll move on then. So it's not all bad news, as in it's not all just, oh God, I've got to get a lot of data and it's a lot of work, which it is if you don't manage it well and properly, but it doesn't have to be. However, remember the third reason we gave you for starting this company, which was once you have financial grade auditable data, i.e. good quality data, it does become really beneficial to you as a business. So let's talk about that now a little bit. Again, I've got one slide just to start the conversation, but let's again start with the question. Again, does your senior management, do you think in your estimation, think that this is fundamentally about compliance, giving other people the data they need, or do they imagine that it could be useful to the business in some way? Again, it'd be really interesting just to get your votes, as it were, or your impressions in the chat, please. So the question is, do your management, your senior management, think that having sustainability ESG data will be useful in the business? Or is it mainly just a compliance exercise as they see it? Good. Exciting. Jake says they see it as a fundamental benefit to the business and not just a tick box exercise. Excellent. Great. We see it as a business opportunity in and of itself. Great. This is exciting. Good. The market is changing. It is developing. People are, obviously, over time, people are understanding more about it and learning. But that's great. Good. Okay. So let's talk about what some of those advantages might be. Again, I'm going to do one slide, and then I'd love to hear some of your how you guys are putting it to use, because obviously, or imagining you will put it to use, because that'll be really interesting. Okay. So from in fact, why don't we do that first? Sorry, Ben, let's go back. Why don't we do that first? So Hayley, you were saying that they're beginning to open up to the idea that it will be useful. Do you want to just tell us roughly what you're thinking, or what you think they're thinking? Haley? I meant talk. Sorry, I meant, do you want to explain to us? Thank you. Okay, fine. She'd rather not talk. That's fine. So, Jake, you're saying that they see it as a fundamental benefit to the business. It'd be really interesting to hear from you as to how they think that might be the case, if you're happy to. You happy to talk, Jake? Can't hear you. Perhaps you're on mute, are you? Okay, maybe Jake doesn't want to talk either. Okay, Anna, are you happy to give everyone the benefit?
Hi, can you hear me?
Yes, brilliant. Jake says he's off mute, but we can't hear you, Jake. Sorry. So whilst you're trying to fix that, Anna will go. Thanks, Anna.
So yeah, I said that it's a business an opportunity in and of itself. I mean, we work directly with companies who are looking to implement improve their sustainability strategies, improve their Scope 3 emissions. So for us, it's fundamental to what we do, thinking about not just how we're reporting, but also how our customers and our clients are reporting as well. Yeah, so it's massively important to us.
Okay. Has anyone? Okay, good. So Jake, if you try now, and if we can't hear you, I'll move on, because obviously your mic isn't working well. Okay, I'll go on. But thank you, Jake, anyway. Sorry about your mic. But we got the point, and it's good that they're seeing it as an opportunity. Right, so what are those opportunities? Let's just talk about them now. Thanks, Ben. We'll go on to the slide. So basically, they're three really solid kind of financially related opportunities, if you will, and then one on the talent side. So the first one, frankly, is that financial grade auditable data helps you attract new customers. Pretty much what Anna was just saying. More and more companies are coming under pressure, as we said, to report reduced carbon emissions, carbon equivalent emissions, greenhouse gas emissions. The only way you can do that, frankly, is by reducing the emissions in your value chains. We'll talk more about this a little later on, but fundamentally, of the three scopes of emissions, Scope 3, which is us guys in the value chain, that is 80 to 90% of all businesses' greenhouse gas emissions. 80 to 90%. So you can see it's virtually impossible to reduce them to any significant way unless you address your value chain. So increasingly, your customers are going to be saying, answer these questions, give us this data satisfactorily. And if you can't, then frankly, we'll have to move on because it's now a condition of procurement. Okay. Now you can imagine pretty quickly, once they get beyond this estimation phase, and the smart ones are doing it now, they're not interested in saying, well, where did you get this data? Did you make it up? Did you go to somebody who just gave you a carbon score, but you don't really know because it was all a black box technology? Did you go to somebody who just told you it was verified, but actually they just self-certified it? Or the shortcut for them is to go, has it been audited or assured by a professional accountant, just like your financials? And obviously that's what they're all going to go to fast. It cuts the work time down for them. Why should they ask you 8 or 9 questions when they can just go, has it been audited by an accountant? Because that's the highest standard we've got. So that's what more and more people are going to do and are starting to, you can see it starting already. And we're seeing that, as I say, through our accounting clients. But there's fantastic evidence of this, that as you if you really have good quality data and you can show that it's been independently assured by an accountant, it can become a growth driver for you. It's a differentiator, because a lot of companies out there aren't as quick off the mark or as progressive as perhaps some of you are. So in the short term, I think it can be an advantage. In the longer term, frankly, I think it'll defend against losing business, which none of us want. I'm going to go to the next purple box. I'll start with the two purples and then we'll do the orange. The purple box there about access new capital. So this relates to the banking regulation I was talking about, and the investor regulation that I was talking about earlier. Basically, as of now, most banks are not really distinguishing between sustainable loans or green loans, whatever you want to call it, and normal lending. But this new regulation is designed to make them do that. So, for instance, they're going to have to reduce their greenhouse gases as well. So you are part of what are called their financed emissions. In other words, they're financing your greenhouse gas emissions. So it's in their interests, if they're going to give you refinancing, for instance, to say, look, we'll give you this much for running the business, but this much, as an example, we'll give you to consider switching your fleet to electric vehicles, for instance. And that's a real advantage to them, because then they can use that proportion of the lending to you to say that it's a sustainable loan, which improves those ratios that I was talking about, which helps them with the regulators in lots of different ways and gives them business efficiencies. Okay, so where we're headed to is, and already some banks are starting in Europe, but also here. I was talking to the CEO of Aviva Investors recently. They have a lending framework which has a 30 basis points difference between sustainable lending and non-sustainable. So I think you're going to see in the future a split in the rate between green sustainable loans and normal lending. At minimum, what you'll see is you probably in a year or two, couple of years, when you come to refinancing, won't get a loan at all unless you can have this data. Because why will the bank take the risk? They have to get their carbon down. And you are 80, 90%, 90% of their GHG emissions in the case of a bank. The only way they can do it is by incentivizing you to do it. Okay, so I hope that's clear. Same way, with investors. So if any of you have got external investors or even VCs and private equity firms who are taking money from big financial institutions, they in turn have to get their greenhouse emissions down, have to report on all these other EU metrics that we talked about. They need the data. They just won't invest in you unless you've got it. They won't continue to invest in you. They certainly won't put more in. In terms of it being decision useful to the business, it really can increase profit. If it's financial grade and auditable, it is therefore of the same quality and consistency as financial data. And that enables me to link it to the profit and loss account. So a very simple example, if I'm reducing water, which we measure in cubic meters, you're saving money. You're not just saving water, you're saving money. Your electricity, your water bills will be down. Okay. If we can reduce your electricity usage, that is reducing your greenhouse gas emissions. And clearly, we know from this difficult time, we'd really like to get our utility bills down, our energy bills down. So there is an obvious link. Okay. Sometimes it's not quite so obvious, but it's still there. If we can reduce our travel costs, a lot of us have done this since COVID, right? It helps the business. It reduces our carbon emissions. Okay. So there's a lot of obvious stuff, and not just around greenhouse gases. Some of it relates to your workforce, for instance. If you can look after your workforce a little better, train them a little better, maybe even pay them a little better, you might reduce the churn and the cost of churn in a business, the real cost, if you work it out properly, i.e. the loss of productivity when that job is empty, is enormous. It's much more than possibly sending them off on a training day every so often. Okay, as an example. So there are real benefits to running your business more efficiently. You know, to work out how to, let's go back to our electric vehicle example. To work out, you know, the return on that investment over 3 years, say, taking grants, etc., into account, you need an accountant to help you do that. And you need to understand the carbon equivalent reductions, but also the depreciation on the vehicles, etc., etc. You're linking these two things together. Okay. The final one, and then I'll take some questions. So, because Craig has asked a question, which I'll come back to, Craig, is not just the next generation. Most of us really care about this, and it's interesting. It'll be very interesting to see in the election what happens. No question, for good or bad, a lot of governments around the world, a lot of politicians around the world are trying to make this into a political football. I think most people in the world, and there's a lot of it, not me thinking, there's a lot of evidence to suggest that, you know, for some people, that's an attractive proposition. For the great bulk of the populations, most people do care about the environment, biodiversity, animal life, their fellow humans. Most people do care about these things and want something to be done about it. So it's not just the next generation, but it does absolutely help retain and attract talent. To give you a bit of color on that, for instance, the accounting body, the Institute of Chartered Accountants of Scotland, changed their core curriculum recently. Accountants have been struggling to, you know, with recruitment generally over the last few years. They changed the curriculum to put sustainability through it. And they've just attracted, they were telling me, I was up there last week, record numbers of applicants and recruits to sign up to study the curriculum. So younger people, but I think all people, many people want and are attracted to companies that care about this and do this properly. Okay, so there's lots of good reasons to do it. Craig asks, does that not depend if you purchase 100% renewable energy from the grid, which is effectively zero carbon? Okay, so no is the answer, Craig. It doesn't. I think if it's okay, we've got a whole section, Ben, I think I'm right on this coming up, don't we?
Yeah, on the different scopes of emissions.
Great. So I think if it's okay, we'll answer your question then, if that's okay. We also want to talk about this phrase zero carbon, don't we, Ben? And particularly what it means. And in fact, we have a helpful handout. Well, we hope it's a helpful handout for everybody. So I'll come to that then, Craig, if that's okay. But the short answer is no. Most utility providers now, most energy providers now have a mix. Some are pure alternatives. Some are still completely fossil. Most are a mix of some some wind, some solar, some natural gas, some oil, etc. So most of them have a mix, and it does depend on which provider you have as to what that mix is. So it's not just one or the other. It's not binary. Very little of this is binary. I hate to tell everybody. It's complicated. You have to engage with it. There is no quick answers. Anyone who gives you quick answers is A, wrong, and B, almost certainly giving you duff information in terms of the value of that information. It's a complex area. It's based on science, which is changing all the time. The law is all over it. It's economics. It's a complicated area. You have to engage with it to really get value out of it. Okay. Anyone else got a question on this space? Okay. What's our next topic, Ben?
The next topic is your favorite.
Very good. Do you want to start off with the scopes 1, 2, and 3? Maybe is this where we have a handout? It is.
Yes, and it is, and we also have we have this lovely diagram as well.
Great. Do you want to go for it?
Yeah. So I guess first of all, I'd like to see by putting in the chat how many of you know about the GHG protocol and the different scopes of emissions. So please just comment away on the chat. Just how much detail I need to go into. Great. Yep, he knows. Okay. Great. So I won't go into too much detail if most of you know. So Ellie here says Scope 3 is the one I'm most uncertain on. We didn't report this year. Okay, great. That's good to know. But really, what I'll show you in this slide is that the breakdown of the different scopes of emissions. So Scope 1 here are direct emissions from owned or controlled sources. So if you're directly burning fuel for your business operations, then again, this is reported under Scope 1 emissions. Scope 2 are indirect emissions from the generation of purchased electricity. So again, if you, as a business, you have an office and you are consuming electricity, that will go down in your Scope 2 emissions. And then Scope 3 emissions, as Ellie had mentioned, is the most complicated one, where these are indirect emissions. And these are all of the emissions that aren't included in Scope 1 and 2 that occur in the value chain of your reporting company. And this includes both upstream and downstream emissions. So we have different categories of the Scope 3 emissions. And typically, they account for about 80 to 90% of a company's GHG emissions. There are 15 categories, as I mentioned, and basically these are basic to help you calculate and report on all of those emissions. And then if we look at the wider landscape, an SME's Scope 1 and 2 emissions, so if you're reporting up to a larger organization, you will sit in the Scope 3 emissions of a larger organization as their customer or supplier. And they have to report then that, as Mark was saying, back to customers, banks, or investors. These large organizations obviously have to report under multiple regulations. So even if as an SME, you don't have to technically report under requirement. Well, a lot of the large and public companies and governments are asking for this data, so you have to get a grip onto it. So what I'll do is I'll just show you through some of the different categories of Scope 3, just so you have an idea of what it is. So we have category 1, which is purchased goods and services. So by definition, this is emissions from the extraction, production, and transportation of goods and services purchased by the company.
Just on that point, Ben, sorry to interrupt. Just so everyone's clear, there are 15 Scope 3 categories, as you see. Some are from the upstream on the left-hand side. Some are on the downstream on the right-hand side. By far the biggest category to all industries is purchased goods and services, which is there. Ben's put the cursor on it there. It's about at 5 o'clock on the left-hand side. There he is. Purchased goods and services. This is about 80% of most, and it makes sense, of most companies' Scope 3 emissions. So it's everything you're buying fundamentally into the business. Sorry, Ben.
Yeah, that's all right. And yeah, I appreciate you doing that. So and then the category 2 is the capital goods. So again, if you've got any goods on your balance sheet that you're needing to basically account for in your financial accounts, this is the equivalent of where those capital goods sit. The third one is the third category is fuel and energy related activities not included in Scope 1 and 2. We've got upstream and downstream transportation and distribution. So that's category 4. Oh, sorry about this.
So just to explain what they mean. So upstream is, for instance, taking delivery of cars from the dealer or from the manufacturer. So that's coming into your business. Downstream is you delivering the fleet that you're leasing to John Lewis. Okay.
Yeah. Then we have waste generated in operations, so emissions from the disposal and treatment of waste generated by their activities. So again, we're trying to account for everything in this Scope 3 category, which is why Ellie mentioned that it's really difficult to get on top of, because this data doesn't necessarily just sit within your organization. This is all the entire value chain. You have another category, business travel, and again, this is all of the employees commuting. This is any expenses that basically come outside of business travel. And again, it relates to flights, rail, road, taxis, etc., and anything owned and operated by third parties. We have category 7, which is employee commuting. So again, transportation of employees between their home and work. And then for a lot of you on the call as well, there could be upstream leased assets. So again, if you're leasing assets, and again, they don't sit on your balance sheet necessarily, then it won't go through your scope 1 and 2, but it will sit in your scope 3. So again, that means that it depends on the control of the actual products themselves. We have processing of sold products on the downstream. So again, this is if you use the goods and services sold by the company, we're calculating the equivalent emissions of that. Downstream leased assets. So again, not only if you lease cars or vehicles from a company, but you're leasing them out to other companies, then again, you need to take into account the downstream emissions related to those leased assets. And then a couple of other ones, which are slightly less relevant, I guess, for businesses within the vehicle space, which is franchises and investments. But again, it's just showing you the entire value chain of the scope 3 reporting. Mark, anything else to mention on this?
Yeah, just so there seems a lot here, and there is a lot in scope 3. The truth is, new research from the London Stock Exchange Group has found that, as I said, about 80 to 90% of most organizations' greenhouse gas emissions is in their scope 3. And of that 80%, about 81% is made up of purchased goods and services and whatever is the next most important category of scope 3. So basically, 2 of the 15 scope 3s make up about 80% of most companies' scope 3. So it's not quite as complicated as it seems. What is complicated, unfortunately, is calculating the carbon equivalent. I use the word carbon equivalent, and we'll come on to that. I've been using it quite a lot, if you've noticed. We'll come on to that in a moment as to why. But the calculation of this there are a lot of people offering it. It is unbelievably difficult to do well. And more importantly, to do it to an audit standard, so an accountant can sign off on it, they need to see what they refer to as the source documentation. In other words, if you say, oh, this is my scope 1, because of the electricity I've used, the accountant will need to see the invoices, the kilowatt hours for every month, and be able to reconcile the carbon number with the kilowatt hours, which he will have also got what they call an emissions factor, basically a number to multiply a bit to calculate the carbon. But the accountant will have to square all that up. He cannot take your word for it. He cannot take the fact that you've gone to some other company and they've done it for you. Irrelevant. The accountant will have to see the invoice and do the whole reconciliation through, exactly as they do on the financial side. Okay, so it's complicated. You've got employees in carbon here, as Ben was saying. You've got all that purchase stuff. You've got leasing agreements. You've got all your travel invoices. You've got a lot of stuff flowing in and out, fundamentally of the accounting system, but also the HR records. So the accounting world needs the source data. Okay, I think that's an important point.
And the other thing I was going to mention, Mark, is that as I mentioned, that they're most uncertain as they didn't report it this year. But again, it's really important to note that it's just a first step to start the process, to start to understand each of the categories of scope 3 reporting. So again, ESG is a journey, and basically we take what data we can have that is available, and then we build that out year after year after year. And so it's about a process and going down that journey. So again, Ellie, if you're concerned about it, then reach out. But I wonder whether Mark, it's worth asking kind of any questions from the floor about their scope 3 reporting.
Yeah, are we going to just run people through that handout in a minute? Is that what we're going to do?
I think Charlotte has put it into the.
Yeah, but can we just point to it on the screen? It would be really helpful if we could.
Yeah,
There's
of course.
a couple of points I want to make. Just whilst Ben is digging that out and whilst this chart is still on the screen, I've been using the phrase carbon equivalent, or CO2e, it's sometimes known as, or greenhouse gas emissions, if you've noticed. And the reason I've been doing that is that carbon dioxide, CO2, okay, as you see, is only one of actually 9 greenhouse gases. So at the top there, you see you've got N2O, you've got CH2, you've got CO2, you've got HFCs, PFCs, there's a whole load of them. The worst 3, the big 3, if you like, are carbon dioxide, methane, and nitrous oxide. Okay, so nitrous oxide famously was what Volkswagen were lying about when they were caught with their diesel emissions in America. Remember? Not so long ago. They were pumping out something like 40 times the nitrous oxide that they should have been pumping out, i.e. really damaging the air, not just here, but also up in the atmosphere. This phrase equivalent means that all these different, the other 8 greenhouse gases are turned into an equivalent amount of carbon dioxide so that we can get to a single number known as carbon dioxide equivalent, CO2e. Okay? And what's happening up there in the atmosphere is that basically these carbon dioxide hangs around up there. It's typically measured in 100-year time frame. They call it global warming potential. And methane, for instance, is up there for a lot less, but is much more damaging when it's up there. So it's only up there for about 20 years, but it's about 7 times worse for the atmosphere and the environment as a result. Nitrous oxide, similarly, is much more dangerous than carbon. So, and some of these other ones, I mean, they're smaller, but they're very important. So that's why if you're buying anything, hopefully from anybody, or even reporting anything, all of the requirements, everybody needs greenhouse gas emissions, scope 3, scope 2, scope 1, they all need them in carbon equivalent, CO2e. So you cannot just report carbon dioxide, it is not the full picture. So this is a good example of having to really know about this stuff and engage with the detail. Okay. If we could show the handout, I think it'd be helpful then.
Yeah, sure. I've got this here. So we have, again, this should be sent to you guys. So this is the scope 3 categories.
Yeah, so Ben's just taking you through those there. Great. We don't need to do that again. That's fine. Okay. Is the diagram on the front? I think Charlotte was saying it was. Yeah, great.
This one,
so
yeah.
You've got a basic description here, as Charlotte was saying. Good. So you've got that. Keep going. Thank you. You've got the 3 categories that we mentioned. And then, Craig, this is beginning to answer your question. My latest, part of my latest research is into the area of greenwashing. Is this where we should talk about greenwashing, Ben, or do we have that on a separate topic?
Yeah, we can talk about that here.
So we don't have a separate topic on it?
No.
Okay. So greenwashing we're all familiar with. It's basically, typically it's intentionally done, and it's lying, frankly. It's saying that we are greener than in fact we really are, or more environmentally friendly, or more socially equitable than we really are. And the classic form of it right now is what they call carbon offsetting. Okay, so offsetting is an idea whereby I emit greenhouse gases over here in my operation, but I can pay effectively to offset them by buying some method of capturing carbon over here. So I'm offsetting. That's the principle. Okay. And in and of itself, offsetting is going to be an important part of the answer. However, offsetting as it is currently available on the market is massively, like 90% plus, available only in one form, and that is forestry offsets. So you've read a lot about this, heard a lot about this. Basically, you pay people to supposedly plant trees for you. Okay. And I'll come back to that. I say supposedly, and I'll come back to why I say supposedly in a moment. The other kind of forms of carbon offsetting available are to do with basically biomass, biochar, things like that, reclaiming swampland, peatland, you know, those kind of reinvesting in destroyed biodiversity, essentially. Where it gets really exciting is carbon capture and storage. It's called CCS. This is a bit like a catalytic converter on a car. You basically stop the greenhouse gases emitting in the first place. You capture them at source, you solidify them, and you store them, or you do something with them. And then the last one is what they call direct air capture, where DAC, where you literally suck carbon out of the atmosphere, which is obviously the best. Now, unfortunately, the best two, the last two I mentioned, capture and storage and air capture, are not available really to any meaningful extent to any of us on the commercial markets. They're very early days technology. They're massively expensive. There are some interesting projects going on around the world with big backing, making a lot of news, but they simply are not available in a mass market way at all. So when people are buying offsets, they're not buying that good stuff. It's not available yet. Some people are buying the slightly better biochar type activities. The vast majority, as I say, are buying forestry offsets. Now, forestry offsets has been investigated by academics, by newspapers. There was a big expose on it on BBC recently, if you saw that. The Guardian and Der Spiegel teamed up and discovered, using academic data, that what they call 93% of carbon offsets are what they call phantom, i.e. they don't exist. Okay? So if you think about the waste of that money, quite apart from the line, the waste of the money is shocking. The courts are now picking up on this. So 14 airlines in Europe, KLM a couple of weeks ago, have just been fined. They've been found to be lying, essentially saying that this flight is carbon neutral. We've all been on planes that have, you know, they claim that because they're claiming to plant these forests. Okay, and the problem is as follows. You don't plant a tree, or you don't plant a forest, right? You don't even plant a tree one by one. At best, you plant a sapling, okay? Now, most of those saplings died. That's just the law of biology, okay? The vast majority of them die. If it makes it all the way through to being a tree, it takes about 12 to 14 years to grow into anything like any of us would recognize as a tree. So the idea that I can keep belching out greenhouse gas emissions, waiting for this poor little tree to grow up, you can see it just doesn't make any sense by way of offsetting. Okay, point one. Point two, God forbid if the tree actually burns down, the nature of trees and carbon is that it releases all the carbon it's ever sequestered in the first place. So it doesn't do any good anyway if there's a wildfire. So all the wildfires in California up to 2017 released all the carbon that was so-called stored between 2000 and 2017. Completely pointless exercise, got nobody anywhere, has not helped greenhouse gas emissions and therefore global warming at all. Okay? But actually, what a lot of people who are selling you forestry offsets are actually doing is, at best, they're loading up seeds in planes, flying over a forest, say somewhere in Madagascar, and they call that planting seeds. Okay? And the final bit is people who own the land are selling the land again and again and again and again. So it's a shocking, it will be outlawed very soon. Already the EU and Britain have said they will not accept advertising on the basis that claims to be carbon neutral on the basis of forestry offsets. So I think very quickly it's being hunted down as a form of greenwashing. I want to just touch on this. I hope that's helpful to you all. Don't waste your money on pretending to be planting trees. Put it in your back pocket and find some other way to spend it. Or if you're interested in saving greenhouse gases, find something that really reduces them. You cannot offset it. We have to reduce. Okay, and certainly forestry will not help you do that. Okay, what is also happening, and Craig, this relates to your question, I think mainly inadvertently, but there's a new form of greenwashing that I'm calling mix and match washing. And this essentially, as you see there, the definition is the deliberate, or probably more normally inadvertent, use of 6 terms in various combinations as if their meanings are interchangeable, which actually they are not. Okay, and those terms are carbon, carbon equivalent, neutral, positive, net, and zero. So very quickly, again, how many people have heard phrases like carbon positive, carbon, net zero, carbon neutral, carbon equivalent? They're all muddled together in lots of different ways, and they are absolutely not interchangeable. Okay, so on the handout, you'll see what the different ones refer to. Carbon, I've touched on, is only one of 9 greenhouse gases. Carbon equivalent, I explained that to you. Neutral, actually, is this idea that somehow you can pretend that the offsets are making your own emissions go away. There is no such thing, really, as neutrality available on the market at the moment. If you're emitting, you're emitting, and there's no way of offsetting it meaningfully at the moment. So anyone who's talking to you about being carbon neutral, they've made 2 mistakes, haven't they? A, they've only talked about carbon rather than carbon equivalent. And B, they're talking about being neutral, which we know now, frankly, is bullshit. Okay? Net refers to the idea of, as it suggests, trying to net out and get to a balance of emissions and real removals over time. But that's only really going to be available when these new technologies come in the future. And then zero, which is what we should be all struggling for as a humankind and individual businesses and people. It refers to the reduction of CO2e emissions to get to as close as possible in our lives and in our businesses. And then only the things that we really, really cannot reduce anymore. It's impossible to reduce them. And there is quite a lot of carbon that is impossible to reduce. Only then do we turn to proper removal offsets. So these terms mean very specific different things. So A, when you're using them, be really careful. And B, particularly when you're buying products and services from people and they give you all this mumbo jumbo, now you know what it means. See through it, question them, ask them. Ask them, is their data being audited by an accountant? That's the best thing you could do. Okay, so I hope that's helpful in that section. Anything to add from you, Ben?
No, I think you've covered that really well, and it kind of segues quite nicely to the fact that we're talking here about about carbon and carbon equivalents predominantly, but we keep forgetting that the ESG topic has a plethora of metrics that this is just getting focused on. Let's just say call them 3 of the overall metrics that we need to report against. So yeah, if anyone has any questions about carbon reporting, then please put it in the chat. I know Zoe, really appreciate that comment. But any other questions for now until we move on to the next part? I think silence is bliss.
Okay, well, here we go. Perfect, Ben. Good segue. Right, so as Ben just said, a lot of us naturally are very focused on greenhouse gases, carbon equivalents, understandable in our business, in your business. But when your companies, your corporate customers, your local government customers, your national government customers, your banks, your investors ask for data, they will be faced with having to fill in and disclose data on all of these metrics, not just greenhouse gases. So we thought we'd help you understand what's known as the EU taxonomy, which is what the big companies have to report on under something called CSRD. You may have heard of that. And the financial companies have to report on it under something called SFDR. Acronyms don't really matter. This is the scorecard they're reporting against. So as you can see, you've got 5 big areas on the left there. There's a big section around greenhouse gas emissions, but also biodiversity, water, waste. So carbon, as Ben just said, is not even the only environmental metric, let alone the only metric in the whole reporting set. Okay, there's also a number around social and employee matters at the bottom. So you've got the three different scopes of greenhouse gas emissions. If we go to the right, the three different scopes of greenhouse gas emissions, as you see there, they also require you to add it all up. They require something that they call a carbon footprint. The most important one here is what they call the greenhouse gas intensity. So basically, you would do it per revenue. So as your business grows, of course, your carbon emissions are going to go up, okay? But the amount of carbon you're using for every extra pound of growth should be going down. So that's the idea of a revenue, of an intensity metric. In the case of investors, they're looking at the amount invested. Those emissions should be coming down. Banks, as we were saying around lending, you know, the amount that is emitted for every pound lent. So this notion of an intensity metric is a very important one going forward. But they're also interested in the share of investments, for instance, in companies that are active in the fossil fuel sector. And then they're interested in the whole renewable area. So Craig, back to your point. And energy consumption intensity again per revenue, as I spoke about. Biodiversity is going to be a very, very big area. Climate change, one of the effects of climate change and of human activity is that we're not only warming the climate and destroying it, we are also destroying species of both plants and animals at a phenomenal rate. Scientists have described it as the 6th mass extinction. The 5th mass extinction, by the way, was the dinosaurs. So that's how fast we're killing species. It's a big deal. And that's why the regulators are all turning to this area now, as are the accounting bodies. That's going to be the next wave of regulation. So all of these regulators and the accounting standards boards are rolling out over the coming 4, 5, 10 years a series of, it's like a production line of constantly cranking up the whole reporting framework to encompass all this broad. But as you see, the Europeans have gone straight in. Waste is obviously a really important area. Water, I should missed water, not bad. Well, our distribution of water in this country is appalling. So I wouldn't be surprised if lots of us had hosepipe bans again this summer, even though it's been the wettest, whatever, spring on record, because we're not good at distributing it around the country and it leaks like crazy because of our Victorian infrastructure. And regrettably, we haven't been investing in the infrastructure. So our leakage rates are higher and our distribution is poor. But many parts of the world don't even have the water there anyway. So water consumption is a massive problem for the world. And that's why it's on this list. And then you move into the social areas. They want to know about gender pay gaps, gender diversity. Are people signed up? Do they have whistleblower policies? Are they signed up to anti-slavery, etc.? I'm not going to go through it all, but you can see it's a pretty full set of measures. And greenhouse gases are not the only ones. So don't just get fixated on the greenhouse gas side. What they call diversity, equity, and inclusivity measures. So ethnic inclusivity, pay gaps, board diversity, these kind of things are really important. And again, you will be asked these questions from on high, so you may as well get the information. Okay, I think that's that one. Does anyone have anything on that?
I guess, Mark, the one caveat to this is that this is the EU reporting regulation, and again, just to go back to the UK is kind of quickly following suit in terms of getting into line with what's actually being required. So maybe we'll just quickly go on to the IFRS S1 and S2.
Okay. But as I said, remember, even if you're a British company, if you're doing business in the EEA, you're a bank. All our banks do business in the EEA. They have to report on this. Being a British SME won't save you, right? You're going to be wrapped up in this. okay? Because the banks you're taking money from or are all doing business over there, they have to report on this. Okay, so this idea that we're somehow on our own and we won't be affected, that's not true either. So that's the main point there, Ben, I think.
Yeah.
Okay. Are we good to talk about accounting?
Sorry, just to interrupt you guys. Jen has got a question in the chat there. Over time, will they begin to issue fines if emissions aren't seen to be coming down?
That's a very good question, Jen. Well, I'm not a prophet. I think there's three answers to that. One is there are fines now. If you break the regulations, there are fines. The way the EU works is that every member state sets its own penalty regime. So because the regulations are so new, some of those are in place, but a lot of them aren't yet. I think they will be. I think a much more powerful measure, though, will be, I think the biggest penalty, the biggest jeopardy will come from the market. So particularly around greenhouse gas emissions, which is what your question is asking. For instance, already you cannot get real estate insurance in California, new real estate insurance, because of all the wildfires linked to climate change. There are other reasons for it as well, but it's right now the insurance market is being closed down there for real estate. Okay. In Britain, if you have a property on one of 3 flood corridors, you are absolutely paying a higher premium right now, even if you don't know it, than people who are outside those corridors. They reckon that Australia, the whole country, will be virtually uninsurable at anything like sensible rates within the next decade. Okay, so I think insurance is going to be a very powerful driver of you better get your emissions down. It's in economics, we call this a collective action problem. Everybody sits around hoping everybody else will do it and I won't have to. The reality is we all have to do it. I think the market will eventually force everybody to do it. And then I think the regulators will follow suit and will start issuing fines as well. But I don't think really, regulation is not the answer to everything. It's there to provide guide rails and suggest what behavior we expect of individuals and companies. Ultimately, government fines. Look at in the case of the post office scandal and blood last night, they take a long time to come through. They themselves aren't really the regulating factor. It's more the expectations they create of how people should behave, and then the market takes care of it. And I think that'll absolutely be the case in terms of carbon. I hope that answers your question. Okay, where are we off to now, Ben? We've only got a few more minutes.
So help with ESG reporting, and to basically show them that there is help out there, and that the calculating carbon isn't just the only thing to do, and that we can support with that.
Okay, why do I suggest you do literally go onto the platform and show them the kind of, we can talk all about the types of data that they need to think about collecting, and the kinds of questions that are involved in thinking about not just carbon, but some of these other metrics as well. I think that would make sense, don't you?
Yeah, or we have a couple of slides in here that we could show that through. So I guess it'd be easy.
I'd rather do it. I think it's more interesting for people to see it for real on the platform. If you can do that, I'll talk while you're doing that.
Fine, I will share my screen for a minute.
Over time, will they? So Jen is. Oh, sorry, we've answered that question, Jen. Yes, they absolutely will. I mean, they're already. Again, I should have said also the other regulatory force in this, which I touched on earlier, is the law. So the other form of regulation, if you will. So regulation comes in many forms. It comes, yes, from governments, which we touched on. It comes from the market, which I've touched on. But we really are seeing it in the law. So companies are having to really factor in reputational risk now for being found out. So KLM have been fined a significant amount of money. Deutsche Bank were fined for greenwashing in their terms of their funds. Goldman Sachs were fined. You know, that becomes an issue from both a regulation point of view, but also a reputational risk point of view for these companies. Delta Airlines, for instance, there's a class action lawsuit in America for $1 billion against Delta Airlines. Now, the money, frankly, isn't terribly important. What is important is everybody talking about Delta Airlines. So there's a real reputational risk that I think is another factor here. But the courts are definitely getting exercised around this. So litigation risk more generally is very real. Let me just touch on it whilst Ben's getting organized. About 2 weeks ago, a group of 70-plus-year-old women, I don't know if any of you saw this, took the Swiss government to court, basically correctly claiming that excessive heat waves means that elderly women of 70-plus are more likely to die, which apparently medically is true. So they said that the Swiss government had a duty to look after them. The Swiss government said, don't be ridiculous, threw it out of court immediately. The women pressed on and got it into the European Court of Human Rights, who 2 or 3 weeks ago said, you're absolutely right. A, the court does have a duty to regulate government's behavior. B, the government does have a duty to look after its citizens and should be reporting accurately and scientifically based on the country's efforts to reduce greenhouse gases, as well as other metrics. And C, and this is a really interesting bit, the drop in the ocean argument doesn't carry any legal water. So Switzerland was arguing, look, it's little old Switzerland, we don't count, there's only 4.5 of us, it's all China and America and India. And the court said, that's rubbish, it's a global problem, we are all in this together, there is no argument of we're just a drop in the ocean. So that court case is seen to be, my colleagues in the law school tell me that's a very big deal. It probably, in their opinion, will create a precedent which will be picked up by other courts all around the world. If that's the case, that could be a massive impetus to encouraging people, incentivizing people to reduce their emissions and improve on some of these other metrics. So that's another form of regulation, if you like, with a small r. Hopefully that's useful. It's a really interesting case. Right, Ben.
Here's the platform that we were asking for, Mark, and again, it's just to basically show the overview of just how simple the data collection piece can be, and then the results. So again, we break
Ben,
down.
I'll just do a little bit of scene setting, shall I? And then you can go into the detail. So I'm only showing you this because I want to demonstrate a couple of things. One is that I mentioned this fact that accountants have to be able to see the source data. They cannot take your word for it. They cannot take another company that you employ, their word for it. Can you imagine going to your accountant and say, don't worry, I've gone to Ben Horn Inc. and he's told me my costs are this. So don't worry about it. Just take Ben's word for it and it's all okay. And your accountant goes, great, Ben's done all the work for me. No problem, I'll sign it off. That's not going to happen, is it? This is no different. The accountant will say, I need to see the costs. I need to see the invoices myself. Okay, so it's going to be that way. So what we've done in building this platform is to try and be as efficient as possible, both from your end as the inputters of the data, potential inputters of the data, and the accountant's end, also potentially inputters, but also users of the data. So what many companies who offer to calculate carbon emissions do is they ask you linear questions. So we want to know this, so we ask about this. We want to know this, so we ask these questions. What we've done here in constructing this is instead of a one-to-one relationship, we've done a one-to-many. So we've basically identified that in most businesses, there is data around what we call financial data, which we're integrating using APIs, Ben will show you in a minute. There is operational data, there's production data if it's relevant, there's HR data. Sorry, Ben, I'm at the top still. Stay up. Yeah, thank you. There's HR data, there's product data, and there's governance data. Okay? And by collecting the smallest amount of data from each of those buckets, we can then calculate, and the accountant can audit the metrics that we want to calculate, and the accountant wants to audit. Okay, so your accountant can work with this machine in exactly the same way they work with QuickBooks or Xero or Sage to do your financial reporting. That's the idea of it. But the key here is to minimize the effort required to upload data and to maximize its utility by this one-to-many mapping. Okay, so the way this is constructed is that we ask for the data in these 6 buckets. So, okay, thank you, Ben, over to you.
So just as an example here, we can take the vehicles, for instance, and on here we ask, does your business own, lease, operate any vehicles, or reimburse employees for fuel? And so you select what's relevant, and again, just to upload the relevant information here in terms of vehicle registration, purchase date, distance driven in the financial year, the vehicle type, the fuel type, etc. And then basically asking whether you're the lessor of this vehicle, so whether you lease it out to your customers. And in this sense, we cross-check that with all the data that we get from the financial data, and this then gets calculated for your scope 1, 2, or 3 emissions. So making it very easy for you guys to input the information, and then on the back end, the calculations happen that this is all calculated on your behalf.
Just show the drag and drop feature there, Ben, which is important because a lot of you guys will obviously have multiple.
So again, if you've got multiple vehicles, then you can input this information basically into our smart importer, and it loads when it loads, and it will basically just ask you for these relevant fields that you can input one document in with all of the vehicle information that you have. Making it really simple to input that information.
So effectively, you can drag and drop your fleet, your fleet records, your vehicle fleet records.
Yeah. The other information, for instance, would be such as employee data, and again, this kind of comes down to downloading a template, and this will highlight all of the different bits of information that you'll need, from ethnicity and gender. The annual equivalent salary of your employees, but again, without any personal identifiable names, because for GDPR reasons, we obviously take that very seriously. And then again, this kind of combines, as Mark was saying, that we'll take all of this information and put it into the multiple metrics that it then measures.
Yeah, and when we say we, by the way, it's more often than not, it's not us, it's your accountant who's using this system to do this work for you. So you know, we do work directly with many of your members, and we've come to some case studies in a bit. But more and more, naturally, because of this integration with financial data, you guys are working with your accountants to deliver this. And so your accountant, for instance, could own the inputting of all of this for you, just like they do on Xero or QuickBooks. Or they could say to you, look, I'll do this bit and this bit, can you do this and this bit? So there is a collaborator function on this platform whereby they could be the owner and ask you to be the collaborator, or they could say to you, can you upload the data, and they'll be a collaborator. And then they can do all the reporting essentially, and critically they can verify it all and assure it, as we were saying. So and that's typically what's going to happen more and more. And I think the way the world is going to go, just like it'll be just the same as financial reporting, honestly. We won't even be having this conversation in 4 or 5 years. It'll just be reporting. And obviously it's on both sides. I mean, that's really where this is heading.
And do we want to quickly have a look at the results just to
I don't think for the moment. Let's do that a little later on. Just go to the accounting section if we could, Ben. Sorry, just for a second. Just to show people how easy it is for their accountant or you yourself to connect the accountancy data. So you can imagine the accounting data is most of, or a lot of, it's about probably 50–60% of all the data we need, or that's needed to do this. And it's connected by something called an API. Many of you will know about these. So then I'll just demonstrate how easy that is.
Yeah, and then so basically this is being connected here, And again, we pull through from just over 20 accounting service providers. So again, all of that data kind of pulls through. It's essentially just pulling that data and the invoices, etc., that are linked to it.
So I think just to help a bit more of that. So most of us probably are using some kind of online bookkeeping system like QuickBooks, Xero, Sage are obviously the big ones. And whether you're doing it directly or your accountant is doing it, everybody's working with those tools and more. So this platform is an equivalent of that on the non-financial side, but it draws a lot of the data from that side and drags it in, which is what this is a kind of conceptual thing of the whole thing, which Ben, you can.
Yeah. Should we so move on to, these are all the metrics and KPIs that we measure.
Just go backwards for a second, just for 1 second. Just talk to people. So we've done the left-hand side of this chart, i.e., not done it, but we've shown you, roughly how easy the platform helps to collect the actual data and groups it in a very minimal way. Just so you know, one of your members actually completed 2 years worth of data in 4 hours by sending it off to the HR person, the operations person, the finance person. So they divided the work, and they were a pretty well organized business, to be fair. But even so, it really can be that efficient. So that's the left-hand side that we showed you. It then goes into the machine, if you like, and this is where your accountant works with it to effectively calculate all those metrics that we looked at and similar metrics. And then at the other end, it gets all reported, which we'll show you in a little bit. But Ben, yeah, go on, have a look at the metrics themselves. I'm just going to...
So as Mark was saying, how this compares to the EU taxonomy, Mark's just gone off for a cup of tea. So basically, this assesses all of the different metrics that you would be required from your supply chain and your value chain to be reporting against. As we said here, we've got your carbon emissions, waste recycling, water usage, energy efficient vehicles, and on the social side, we've got jobs created, average salaries and wages, gender and ethnic diversity, etc. So it covers a plethora of all of the metrics that you'll be required from your stakeholders to report against. And then what we were saying was that it's financial grade data. So again, it can be consistent and comparable with financial data, compliance ready. So it's for new and evolving regulation and aligned to all of the incoming, the UK regulation. So IFRS S1 and S2. The data again is assurable. So it's no longer good enough that you just have data behind a black box and just say this is the data we have. So again, if your stakeholders are asking for it, you can also assure that data to limited assurance standards, the ISAE 3000. And then again, what Mark was saying was that this is all eventually going to be integrated into your accounting, and therefore it's preempting what inevitably is going to be happening in the reporting world.
It's more than inevitable. They've actually said that is what will happen. That's their stated goal, the IFRS.
Yeah.
Yeah.
And so, shall we? Do you want to look at the results, Mark, or should we move on to the next part?
Should we have a quick look at some results and then maybe do some case studies, and then we'll be open for questions and whatever.
So basically, just to show you here, this is some of the output that we get from the platform, and again, just to show you the CO2e emissions topic we have here, tasks and insights on your business. So again, we break this down by location-based and market-based emissions, depending on what we have. The intensity metrics that are increasingly important. So if you're growing as a business, we are calculating this based on the revenue increase in your business. So again, if you're increasing your emissions, but you're increasing your revenue substantially more than that, then again, your intensity metrics will decrease. And then the breakdown between scope 1, 2, and 3 carbon emissions, as we were talking about, in each of the detail that you need in terms of purchased energy, and then all of the categories of scope 3 that are listed out here. And as you can see, some of the largest ones are purchase goods and services, upstream distribution and transportation, etc. So again, if you are going through this process, then you'll start to find out the real impact of that. Again, we break it down by different facilities as well, so you can have a real deep dive and understanding of the data that's impacting your business. Any other sections you want me to cover, Mark, or are we? I
think have a look at on the people side now instead of just focusing on CO2 all the time.
So with regards to employee data, we obviously get total number of employees with joiners and leavers, so we get an attrition rate, and then we calculate the employee support and training that you give to your staff. So again, we have it's all part and parcel of being a good business where you're supporting your employees, and part of that is to give support other than just salaries and wages, and paying for training so that people can upskill themselves. With employees, we can see the breakdown between operational, managerial, senior management. So again, this is very good in business intelligence tool. And an interesting calculation here that Mark can talk more about, but the cost of replacing talent is being calculated so that if someone is asking, if Sally is asking for a pay rise, and you don't know whether to give her that pay rise or not, we can calculate that based on a CIMA report that calculates.
And again, you know, we essentially being your accountant using this platform is where this is going to go more and more. It's not really us particularly; it's our accountant, your accountants really. I mean, it can be us, but more and more it's going to be your accountant. So, sorry, Ben, keep going.
Yes, and then the other section is gender and ethnic diversity. So again, just the breakdown here by across the business in terms of operational, managerial, senior management, and by facility, etc. So it's in line with all the required information. So that's just some of a flavor of some of the results that we get from here.
Right. And there is an overall kind of scorecard based on those metrics that Ben just showed you. You see whether you're up and down. It's all the stuff you'd expect. And at the end of it all, your accountant can issue you with effectively a report that looks just like your financial report. You know, it'll have your directors saying, yes, this is all, you know, we gave good information. It'll have a report from the auditor basically issuing what they call a limited assurance statement saying, this is fine as far as I can see. And then it'll have this year versus last year, the breakdown on every metric. How are you doing against benchmarks, etc. Exactly replicating a financial report, really, but just on these metrics. Okay.
And then once you've done that, you'll be able to promote your ESG credentials to win business, which is ultimately what we all are here for, which, you know, eventually, essentially, these are business decisions, and you need to make sure that this has business sense for you as well, not just for compliance reasons, as Mark mentioned earlier. Is there anything on this in particular, Mark, that you want to cover?
Not really. I think we could go straight to the case studies, couldn't we?
Yeah. So just a few case studies and industry approach. So some of your peers have already been doing this, and we've again highlighted here that some of the real benefits that we've had of them taking part in the ESG reporting process. So using Omnevue helps to track, manage, and improve environmental impact and social responsibilities governance practices. This includes monitoring, reducing emissions, improving driver safety, ensuring compliance with regulations. So again, just a flavor here of some of your peer companies that are already starting reports on ESG data and why they found it so important. And then something else I thought we would mention, Mark, is that industry approaches. So again, benchmarking and the understanding of the importance of doing this as an industry and working together.
Good point, Ben. Yeah.
So I wonder whether you want to speak more about the way that we've been doing this within the hospitality sector, and just how that's kind of transforming the way that companies are starting to respond to it.
Okay, yeah. It goes back to this collective idea that I mentioned earlier. I see Toby is on the call. So obviously, as an industry, you are a very important part of the UK's greenhouse gas emissions as well as a very significant employer in your local communities, but also across the whole economy. So as an industry, quite apart from us as individual businesses, we have a responsibility. And obviously that's what the BVRLA is there to look after, your interests, both as members, but also as an industry, your collective interests. And in that context, I think, you know, the more firms we can get using a standard set of thinking about this, I say we, I'm putting my BVRLA hat on here, the more data effectively Toby and the corporate affairs department and, you know, that report you do every year, the more data they have essentially to put the industry's case forward, to demonstrate what you as companies and therefore as an industry are doing about this, the contribution you're making both to the economy, but also to the sustainable future, sustainability you know, of the economy going forward. It's a big deal. And I think the more you do it as individual companies, that effort, if you will, not only benefits yourselves, but is amplified through the industry voice that you all are all a part of as well. And that's obviously what Toby and the team look to amplify and to put forward on your behalf. So I think that's a really important piece of this. It's not just all about me, me, me. There is a we involved in all of this. And we do similar exercise with the hospitality industry, just to touch on it there, staying on greenhouse gas emissions, just because we've been talking about it a lot, but we're working now with a body that basically it's a tool that the investment world is using to decide when assets are stranded or not. And we're looking to produce enough audited data that people can trust so that the person who runs this tool, a body called CREM, will adjust their benchmarks to be a bit more sensitive to the different types of hotels that exist. So obviously a spa is completely different than a Central City hotel, as an example. So I think the industry voice is a really important one. Yeah, thank you, Ben.
Great. I wonder if now we want to get some questions from...
Yeah, there's actually two here that I promised to answer, so I better do it. And Ben, they're both, I think you can have a crack at them both. From Jen, when a business is fluid and vehicles are constantly changing, how would you best report this? So how is that dealt with by accountants? With your accounting hat on here.
Yeah, of course. So that's a really interesting point, Jen. And again, it goes down to how you would initially report this on your financials. So again, if you are owning the cars and they are on your balance sheet and then they're being bought and sold throughout the year, then again, we do exactly the same methodology for how that's done in terms of accounting for your vehicles, which is why it's so important that accountants are starting to be the ones that are dealing with your carbon emissions. So again, let's just take the example, you do a financial reporting year, January to December, and all of the transactions and everything that's gone through the business within that period of time will be accounted for in a certain way. The exact same thing here with the carbon emission equivalent of the vehicles in that business. So again, if you purchased it in March and you sold it again in July, then again, how many miles did that vehicle do and what was the impact for that period? But we're looking at one financial year's worth of information, and that's hopefully answering your question there.
That's great, Ben, thank you. And the mention of miles is perfect for Adam's question. As a company leasing vehicles out on long-term contracts, we will not be aware of the mileage some vehicles have traveled within the financial year. Is there a way within the platform to negate that issue?
So again, this is a really interesting point that we've had some of your peer companies asking about, which is if you are leasing vehicles on long-term contracts, then again, none of the actual emissions in terms of the fuel that they consume, etc., goes through your scope 1 or 2 emissions. So this will sit in your scope 3 emissions. And again, this is about the waterfall. We have something called a waterfall effect of calculating the data. So the best thing that we can do is get actual activity data. So again, if you can get that from the companies that you're hiring these vehicles out to, and they have the information about the distance traveled and the mileage, etc., or even the purchase of fuel, etc., then those calculations can be done, and we can do that. Otherwise, we basically use what we call basically average data in terms of getting the approximate data that we can get and making as best effort as we can to calculate the actual impact of those emissions. So it's all really relying on data availability and what is available. But then the more you do this process, the more you have an understanding of what you need to get for the following year. So the best thing to do, Adam, is to start to understand what data you have and what's available. And then from there, you can work out a way to basically get that ultimate data.
Yeah, one of the things you can do also is you can look to the car manufacturer and see what their emissions are. But it's a double-edged sword, remember, because as VW pointed out, just because they're giving you an emissions score doesn't mean it's true. So you need to check in this waterfall that the platform uses. It basically checks whether VW emissions, let's say, have been audited themselves by an external auditor, just like their financials. If they have, then that data can be used to calculate an emissions factor per mile traveled or per money spent or whatever it may be. So there are different methods within this waterfall idea, that, as Ben said. But I think, yeah, I mean, fundamentally, the best thing you can do is just to get the logs from whoever you're leasing it to. And if they're not available, there are these other secondary, all of which are perfectly allowed, by the way, under the regulation on how greenhouse gas emissions should be calculated.
And to that point, Mark, we've got a question from Craig as well. Good. For carbon reporting through ESOS and SECR and possibly ISO 5001. With the ESG reporting requirements, there's now a shed load of duplication we have to deal with, and we've had this with many of our clients. So I guess I can kick this one off, but again, Craig, all of this data is being requested from so many different stakeholders, and again, it's important to do it once and once properly, and that's the data that is calculated and that you can then put into all of these different requirements. You've got to make sure that you can have accountable data, and therefore the actual results that you get from the scope, the scope 1, 2, and 3 emissions from our reporting can go into an ESOS report, an SECR report, etc. But again, they're trying to make sure that this is all aligning so that there isn't duplication of work. But yeah, unfortunately, that's something that we've seen.
Again, I think, just to add to that, I think the choice of the metrics is really important. So the ones that are in the scorecard as it currently is, I don't know if you touched on this, Ben, I was out, but I had to go to the loo, but I've been very carefully chosen to align with those questions that are in the EU regulation and in the British regulation and in the accounting standards. So the idea is that's a core set of metrics that are going to be required by everybody. So you may as well start there. So there's actually more standardization than it feels, because I agree with you. It feels like there's loads of duplication, and there is. But actually, when you really look at it and you clean away all the fog, actually, there is a core set of metrics. They are the EU ones that we looked at. They're pretty clear. You can get very close to those. We've designed, for instance, the scorecard that Ben showed you to be, I think it's got an 80% alignment, 78% alignment with those metrics. The reason it's not higher is because we don't sell controversial weapons and have hazardous waste. Otherwise, it would be 100%. So it's a deliberate attempt to get to a core set that will be useful for many purposes, and as I say, is aligned with the new accounting standards. The other thing I'd say is there's another potential piece of duplication, but actually it isn't, whereby auditing can be done through an ISO route, as well as, instead of a professional financial accountant, if you like. So there isn't duplication there, as there isn't anyway. But there isn't in this space either. So you don't have to, in other words, get it done by the ASO and then get it done by your accountant as well. As long as it's a certified auditing body and a regulated auditing body, then their verification will suffice. What won't suffice is the kind of companies who go, oh, you get a so-and-so verification or certificate. And you go, well, who issues these certificates? Well, we do. That won't suffice, obviously.
are there any more questions from the floor? We'll more than happy to answer any questions that you might have or have had during the masterclass.
Why don't you put your email up there, Ben, and basically everyone can write to you and Daniel and book in sessions if they'd like to know more. I'll just keep an eye on this in the meantime. Question from Jill. I can take it whilst you're putting all that stuff on screen.
Okay.
Do you believe that emerging Scope 4 considerations will become a focus of attention for measuring and reporting? Very good. Some of you know a lot about this. This is great. Oh, God. Without opening a whole can of worms, Scope 4 is the idea, for instance, just to give you an example of well, first of all, Scope 4 is an idea that's beginning to be floated around, has been for about the last year and a half, something like that. So the truth is, it's not clear what people mean when they say Scope 4. One meaning, to give you an example, is if you're a consulting firm, the emissions that you are creating through your consulting advice could be classed as Scope 4, as an example. Okay? I don't think so, Jill, is my honest answer. Certainly not in the next decade. I think it's a red herring, frankly. I think it's a deliberate attempt by bad actors, of whom there are many, to try and add to the fears and the complexity. If I'm honest, that's a personal view. I don't think it's serious in terms of the regulator. I don't think it's on the regulator's agenda or the accountancy world's agenda to put this in at the moment. They're very focused on getting 1, 2, and 3 working. Yeah, exactly. View. And just generally, when I say bad actors, guys, there are. I mean, this is the reality. This, for those of you who care about the environment and social side, we'd like to see a lot of this happening. There are people who don't take that view. They do take the view that climate science is a hoax. I mean, President Trump is going to tell us that. He tells us that every day. And there are a lot of people who believe him and want to believe that, not just in America, here as well. The conservatives have done a lot to reverse policy, irrespective of your politics. Some people agree with that, some people don't. I'm not commenting, but this is not a natural, or it's definitely going to happen thing at all. I think it is up for grabs. And a lot of companies, whilst they're complying with these regulations, are also spending billions lobbying against regulations. For instance, the fossil fuel companies, lots of companies do that. So it is very unclear, the whole space, and what the regulators are trying to do, the governments are trying to do, and the accountancy standards are trying to do, is to bring some business as usual and some clarity in this whole area. But there are a lot of people trying to derail that, hence selling carbon offsets that aren't really offsets. In my opinion, the idea of Scope 4 is one of those. The very idea of a carbon footprint, to give you a real illustration, was invented by, it was Shell, I believe, or BP, one of them, which was really an attempt to switch focus to make it a consumer problem rather than what people call a big oil problem. So there is a lot of, disingenuity going on, which is always the case in the world. I mean, there's nothing surprising. But I think that's Scope 4, hopefully, answered. So, yeah, so it's in there. Do we have it on a slide, Ben, so everyone could see it on the screen more easily as well? Is it on a slide, your email?
Yep.
Put it on there. Good. So there it is down the bottom left, all his details. And yeah, if you want to talk to us more, I think get in contact with Ben. He and Daniel will look after you very, very well. We have other people required if it gets, very technical or expert, whatever. Obviously, they can call on the team. So hope you enjoyed that. Thanks very much, Mark. I see you're coming back in, which is great because we're just about out of time.
No, that's lovely. Well, I just want to say a massive thank you to yourself, Mark, and Ben, for an insightful, useful, practical session on such a key subject. I think you've covered all the bases there about having a ESG strategy, or it might be the pitfalls of offsetting, promoting ESG credentials, a whole vast of different areas. So no, thank you very much for that. Just to let everybody know, post this session, we will be providing handouts, access to the recording of the session as well, and details of how you can activate your one-to-one session with the chaps at Omnevue. So that will follow, like I say, post this session. But other than that, thank you ever so much for attending. And we look forward to speaking to you soon with another masterclass. So thank you very much.